Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Dana Dioria. She's the co-chief investment officer and group president at Envestnet Solutions to discuss why advisors are having success incorporating hyper-personalized solutions into their practices. And of course, we'll also take a look at some macro themes in the market. Dana, it's great to have you back with us. Welcome to Trade Talks.
Thank you. Great to be here.
Let's start with the personalized solutions, particularly in the areas of ESG, diversity and inclusion, and tax. What are clients asking for, and why is it working and so successful for advisors?
Yeah, I think what you're seeing is customers more and more now expecting tailored solutions in their portfolios. So they're asking for their advisors to be able to manage on a deeper level, right? And do things that are not just sort of out of the box packaged. It doesn't mean you can't use ETFs or mutual funds packaged products, but they expect the delivery to be done in such a way that it's tailored to them. And that just goes in line with what they see in the rest of life, right? I mean, we're just so accustomed now to a world of digitization everywhere we look, you know, following us around on the internet are ads tailored completely to us based on something we just looked at, right? So it's not surprising at all that customers are expecting that same level of tailoring and personalization from their financial
positioning in the current market environment right now, which has been volatile for 2022, starting with equities. What are your thoughts there?
Yeah, it's a tough market for sure. And you mentioned some of the hyper-personalized products. I think as a starter, if you're an advisor and you want to keep the client disciplined, doing some of these hyper-personalized type solutions can help with that, meaning, you know, sustainable investing, and that could be across the political spectrum, but it engages the client more. You know, maybe there's something in there that speaks to them on a deeper level than just what's my return at the end of the day. If you're talking straight markets, I think there's a couple ways to look at it. One, we're clearly in a rotation to value after years of rates being just so low, and growth companies where a lot of the value was in the terminal value, that kind of has been upended this year. But quality, low volatility, these are the standard defensive positionings, and I think, you know, those are kind of where the traditional advice would be to go.
What about fixed income?
Yeah, it's tough, right? I mean, we're sitting in a market where you're not only experiencing double-digit losses in equities, you're getting double-digit losses in your fixed income. This is just sort of an unprecedented experience for a lot of advisors practicing today. Where do you go? So I certainly think one good aspect of this is the fact that now you can get some yield, right? So if you're a fixed income investor, you know, you were kind of dealing with financial repression for a while where you really weren't getting any return. Now the return is there. You know, these years of going to dividend paying stocks instead of being in fixed income, now there's comparative analysis that has to be done. Well, maybe I should be in the fixed income, right? So there's income producing opportunities there. Another thing that we see happening a lot is annuities, interest in annuities going up, both because of fixed income concerns and the fact that you can have a big capital loss even on the fixed income side, but also because protection, of course, from equity markets. I mean, there's a reason they call it insurance, right?
Yeah. Speaking of interest rates, what's your outlook on Fed policy and what's happening with interest rates and inflation?
It's, I think at this point, I match pretty much what you're going to hear. And so if you had asked me over the summer, I would have said, I do think the Fed stays hawkish. There was obviously during the summer this expectation that maybe there'd be some sort of pivot. The Fed put would be back in play. The data just didn't really seem to support that. I think at this point, you know, we're all kind of aligned. The Fed remains hawkish. The Fed has been very clear. They keep coming out, different Fed governors coming out saying, hey, look, we're not going to let up on inflation. We have this target. We're going to get to that target. There's going to be pain, i.e. recession probably will accept that. So expect continued hawkishness, probably another 75 in November, maybe 50, but you know, markets have to contend with and are pricing in that expectation.
Yeah. Well, it's so interesting because it seems as if there's this investing strategy based on hopium, hoping that the Fed will do something. And you know what, we saw the same thing happen when they kept continuing to cut rates and questioning what the strategy was behind that. And it's the same thing on the upside too. The Fed is going to do what the Fed is going to do until it doesn't anymore. And there could be pain on both sides of that trade. But when we think about inflation, Dana, it's not just an issue in the US.
Oh, 100%. I mean, this is a global phenomenon at this point. Countries across the globe dealing with inflation. The Fed has been particularly hawkish about dealing with it. And the Fed is kind of empowered by the fact that unemployment has remained very manageable. The jobs market has remained very strong. So they're really kind of given the green light to keep going. Other central banks are, of course, raising rates, but arguably not at the same pace and with a little more concern around what the effects are on growth. But 100% it's an issue. And of course, that's why we're seeing a very strong dollar. We're seeing money flow to the United States because rates here are, going up at a higher pace.
All right, Dana, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.